Welcome back, everyone. What you are looking at right now is not a simulation of the perfect market. This is the actual equity curve of a 100% automated bullish flag strategy running on the NASDAQ futures. A lot of algorithmic traders dismiss classical chart patterns as subjective or impossible to code. But as you can see right here, when you quantify this pattern correctly, the edge is absolutely undeniable. Let us transition over to the performance metrics so you can see exactly what is driving this steady climb. We are looking at 542 trades over the testing period, maintaining an 81.5% win rate. Total net profit is sitting just shy of $79,000, while keeping the maximum drawdown contained at roughly $6,400. Notice that the profit factor is a solid 1.7. This is not a noisy, high-frequency bot. It is a highly selective system that waits for structural confirmation before deploying capital. Now let us get into the engineering behind this, because this is where the magic happens. Look at the chart. You can see the indicator literally draws the pattern on the screen for us, highlighting the pole and plotting the regression channel for the flag. But how does it actually know it is a flag? It breaks the geometry down into two distinct, mathematically defined phases. For the pole, we are not just looking for price to go up. We are measuring pure momentum through velocity and drawdown. If you look at our parameters, we define a minimum pole velocity measured in ATR per bar. This ensures the move is a genuine, aggressive impulse and not just a slow, choppy grind upwards. We also strictly cap the allowed drawdown during this impulse phase. If the price dips too much while forming the pole, the algorithm invalidates the structure entirely. Once a valid pole is locked in, the algorithm shifts to hunting for the flag. It uses linear regression looking backwards to find a consolidation phase. We enforce a negative slope, so we are strictly buying pullbacks, and we constrain the channel width using an ATR multiplier. But here's the real filter. We calculate a dynamic quality score based on the percentage of bars within the flag that make lower highs. This confirms we are entering an orderly retracement, not a chaotic chop zone. The entry trigger itself is incredibly clean. As soon as the price closes above the upper regression line of our channel, we execute the long. Now I want to share the specific mechanic we are exploiting here regarding risk management, because it goes against conventional retail advice. Look closely at this sequence of trades on the chart. First, we have a standard win. We enter long with a quantity of 1, and we hit our profit target. Then, shortly after, we get another setup, but this one fails and hits our stop loss. Notice the parameters for our fixed risk. We are intentionally using an inverse risk-to-reward ratio. Our take profit is set very tight at 1 ATR, but our stop loss is set much wider at 4 ATR. Why would we do this? Because in algorithmic momentum trading, tight stops just get hunted by market noise. Giving the trade massive breathing room is exactly what pushes our win rate above 80%. But how do we recover when that wide stop inevitably gets hit? That is where the position sizing logic kicks in. Move your attention to the next trade immediately following the loss. You will notice the position size has doubled to 2 contracts. We are implementing a controlled martingale approach via a loss multiplier parameter, because we know our statistical probability of suffering consecutive losses is incredibly low with an 81% win rate. We use the math to our advantage. We take the hit, double the size on the next high probability setup, instantly recover the drawdown, and get back to pushing new equity highs. It is aggressive, yes, but when paired with an edge this sharp, it is statistically devastating.